it is, bro.
Okay.
Let it rip, dude. Hit a home run.
Come on now.
Do it.
Uh, so today we're gonna be going over individual life insurance contracts, provisions, and options.
Okay.
What we could do is, if we score a good score on it, we'll move on to the next one, to the policy writers, right? But if we don't, what we'll do, we'll take the same test over again. How
Okay.
about that?
Okay.
Okay. Does anybody have any questions?
No, just everything new. It's time to learn.
Okay, let's do it.
I wrote two, thinking it was February. We're already in March.
Yeah, ain't that something, right? Okay, so question number one. Which of the following statements about a suicide clause in the life insurance policy is true? Okay, so now we're looking for one that is actually true. The rest are completely wrong. Okay. A, suicide is excluded for a specific period of years and converted thereafter. B, suicide is covered by a specific period of years and excluded thereafter. Or C, suicide is covered as long as the policy is enforced. Suicide is excluded as long as the policy is enforced. Okay,
Well,
now let's read it. Let's read the questions one more time. Right?
yes.
Which of the following statement about a suicide clause in the life insurance policy is true? A, suicide is excluded for a specific period of years and covered thereafter. Or B, suicide is covered for a specific period of years and is excluded thereafter. C, suicide is covered as long as the policy is enforced. D, suicide is excluded as long as the policy is enforced. Okay,
Okay.
now let's do this. Let's do process of elimination, right?
Right. Right.
We know it's definitely not D. You know why?
Right.
Because just because the policy is enforced doesn't mean that it's gonna cover suicide. Okay. And
Right.
then C, that let's look at C. Suicide is covered as long as the policy is enforced. So is the covered is mostly covered, then it would, right? But if
Right.
it's not covered, it wouldn't. Compare it to these suicides excluded as long as the policy is enforced, and some are excluded. Basically, it takes out and it just doesn't cover it, right? Or B, suicide is covered for a specific period of years and it excluded thereafter. So let's just say, you know what? We could only cover suicide after the first 4 or 3 years that the policy has been enforced. Okay. After that, we'll even cover suicide, right? Or A, suicide is excluded for a specific period of years and converted thereafter. Okay. So
Right.
basically, what this was trying to say is that throughout a period of time, you would have the writer, then it would convert to like another thing. So which one do you guys think is true?
Well, since I knew about having personal coverage, it's rule out C, rule out D, definitely B. So it's got to be A. A. Letter
A.
A. Yes.
Okay, let's do letter A. That is
Yeah.
correct. In most states, if death results from suicide within a certain period of time, the insurer is not obligated to pay the death benefit. Here with Primerica, it's the first 2 years. The first 2 years, passing the first 2 years, we even pay suicide. Okay.
Okay.
Does
Yes.
anybody have any questions?
No, it's a little kind of scary, but I mean, I know it happens. I know it happens.
Yeah. Okay, let's go on to the next one. According to the entire contract provision, what document must be part of the insurance policy? A, agent's report. B, outline of coverage. C, copy of original application. D, buyer's guide. Let's read it one more time, okay? According to the entire contract provision, what document must be part of the insurance policy? A, agent's report. B, outline of coverage. C, copy of the original application. D, buyer's guide. Okay, let's focus on doing process of elimination from D to A. Okay,
Okay.
so let's look at D, buyer's guide. So when you get a life insurance, and you get a buyer's guide. I actually have one right here just so you can see it because I knew this one was gonna
Yeah.
be it. So here we have, right, the policy, okay? And a policy, a buyer's guide, it's this one. Okay. Buyer's guide. Okay. This is the buyer's guide. B. I'm sorry, C, the copy of the original application. See, here, since it was turbo, it's not the original. It's pretty much just a copy, okay? B, the outline of the coverage, which is over here, right? You don't really need the olive, right? Like, it's just like a basic illustration. Or A, agent's report. An agent's report is basically, let's just say the client had extremely a lot of pills, right? And they say, no, I'm actually healthy. But you inside your gut was like, well, why do you drink like so many pills? Like, why is there so many pills in your bag? So you write in the agent's report, client had extreme like exaggeratedly a whole bunch of pills, and you will note that, right? So which one do you feel like it's a document that the policy must have?
It's the A, right? Because it's a valid from, but it's a valid document from the person who represents the insurance company.
Okay, let's try A.
I'm assuming it's that one.
Let's try it. It's actually C. It's the most important thing to have is a copy of an original application. Why is it important to have the copy of the original application? So if you do it electronically, it still prints you out
I
the
see. Okay.
same thing. All the signatures are here, everything here, all the medical questions are answered.
Okay.
No. So you need an application, either a copy or just the original, right? Why is it important? Because when, let's just say, somebody passes away, they revise the policy and they go, well, you stated here that you didn't have this.
Oh,
Okay. And when it's a contract, just remember, if you want to write down this, contract equals original application.
okay.
Okay. Let's move on to the next one. Does anybody have any questions? Okay, let's go. What type of account will most likely be established for a minor? A, trust. B, annuity. C, credit life. D, estate planning. Okay, let's read it one more time. What type of account will most likely be established for a minor? A, trust. B, annuity. C, credit life. Or D, estate planning. Okay, does anybody want to know or give it an idea of what does estate planning mean?
Probably like build kind of like a cash flow for a particular person. Would that be?
Okay, yeah, that sounds pretty much. Okay, now letter C. What is credit life? Remember how we went types of policies and we
Yes.
showed you guys what credit life was when you owed somebody and that example. Do you guys remember?
Yes. Yes. Yeah.
Okay, credit
Credit
life.
life is I'm sorry. You wanted to continue?
No, go for it. I'm listening to
No.
you.
Credit life is when you borrow, let's say, X amount of dollars. So the only beneficiary is the creditor.
Okay.
So when the person dies, the debt is paid to the creditor. The beneficiary is the creditor. And I
Okay.
don't think a minor is qualifies for that.
Okay, so we definitely know it's now C. Okay. So now what does annuity mean?
Annuity is, well, like paying a person funds as long as he lives. So I
Okay.
don't think a minor qualifies for
Okay,
that.
now in A, what is trust like that? Oh, I mean, let's make him a
A
trust.
trust. Uh, a trust. I'm not familiar with that term.
Okay, So basically a trust is somebody you will leave like in charge to certain amount of important documents. So out of A, B, and C, and D, which one do you guys feel like it's more familiar to what the question is asking?
A.
A? Okay, let's try A. That is correct. The trustees are commonly established for minors to create a scholarship fund. What's a trust? A trust is somebody who's in charge of
Okay.
something. So let's just say a trustee of the kids would be the grandma, right? So that person would be pretty much in charge of everything, right? It
Okay.
would be in charge of like going to school if they need to be in scholarships or whatever they need to do. A trustee, it's always gonna be somebody that's gonna be in charge of something, something that basically the word means trust, right? Like who would you trust your kids with? Who would you trust your minor with?
Right. Yeah, a loved one.
Yeah, right. So
Or
does anybody have any questions on this one?
no,
I
no. It's,
do.
Okay, go for it.
So in order to set up trust, like in the future with clients,
Uh-huh.
you need a securities license, right? Or no?
No. To open a trust, you don't need a securities license. We actually provide that by something called prepaid legal, which a client would pay an additional $28 for it. And not only do you get a trust, you also get a will.
oh,
And that's
okay.
included with the life insurance policy?
It would be separate, but as soon as the trust and the will is over, they don't have to pay monthly. So let's just say, for example, this whole process to decide it takes 1 month, right? 2 months, let's just say. So you would pay 28 this month and 28 the other month. After you already have the trust and the what was I thinking? Man, I just went blank. So whenever you have the trust and the el testamento,
Will.
the will. So once you have it, what you do is like you could cancel the program and it's absolutely free counseling, or you could continue it just in case you need any legal background, such as like, for example, you got a contract from your apartment from your lease, right? And then they didn't want to give you your deposit. They'll send you a letter, obviously. You send that to the lawyers, they'll explain what it is and they'll fight for you. I don't know if that makes sense. Or if you want to make contracts, like say, oh, I want to borrow this person money. I want to make a contract, but you don't know what's how to guide. Let them know. They'll give you a legal contract where it is established as a legal contract. So it's good to have something like that, especially if there's minors involved. Give them the whole financial needs analysis.
But what about us as like once we get our license to sell life insurance? Are
Okay,
we able to do that?
you could actually sell that without a license. Okay, you could start making money off of that already. I would talk to your upline and tell them to if they could go through a little bit of PLPP, Primerica Legal Protection.
Okay, thank you, George.
Yeah, no worries. Anytime. Question too, if it's something about that too. Yeah, you guys could definitely start making money with that and home and auto, right? You could sell help families in the area of car insurance and home insurance without a license because we go under the broker's umbrella. And you could also sell Vivid and get $250 for each system that you sell. And it's like an alarm system while you get your licenses.
Okay.
And for Vivid, if I'm not mistaken, correct me if I'm wrong, you'll get an iPad your first time selling a Vivid. Okay, correct. I'm not too sure. Don't quote me on that. But I haven't sold a Vivid in forever. But you guys can start making money without a license. And if you guys have any questions about that, I could go over that when we're done.
Mhm.
Okay. So the next one, question number 4. Which of the following components must the life insurance policy have to allow policy loans? A, cash value. B, dividends. C, flexible premiums. Or D, phased amount. Let's read it one more time. Which of the following components must a life insurance policy have to allow policy loans? A, cash value, B, dividends, C, flexible premiums, or D, face amount?
Okay, let's rule out.
Let's do process of elimination.
Okay.
What does face amount mean?
I don't know that definition.
Face amount, it's the amount paid out. Like, let's just say you have a policy of 100,000, right? What I gave you is the face amount, which is in whole the money, like everything. It's just boom. That's what it's called, like just the
Okay.
money given out, right? Flexible premium. Do you guys remember what flexible premium is?
Premium.
So premiums is what you pay. So
Right.
let's just say the payment that I give, that's what's called premium. So it
Premium.
flexes the premiums, right?
It's payment.
Dividends is basically what you get out of either from like investments, insurance, like pretty much
Even
like
annuity, right? Even annuity.
yeah, some type of like interest. That's what you get out of it. And cash value is a policy that has money cash valued into the policy, right? Some people use that as saving, as an investment. So which one out of these four sounds more accurate to what the question is asking?
A.
A. Let's do A.
I think A too.
And that is correct. It is cash value. The policy loan option is found only in policies that contain cash value. So when somebody has a cash value, you could take out money, but they'll charge you from 6 to 8% of interest to borrow whose money? Your money. Okay. Does anybody have any questions?
No, it's perfectly
Okay.
understandable.
Okay, using a class designation for beneficiaries means, okay, naming an estate as the beneficiary, naming each beneficiary by his or her name, naming beneficiaries as a group, not naming beneficiaries. Let's read it one more time. Using a class designation for beneficiaries mean, what does class designation mean? A, naming an estate as a beneficiary. B, naming each beneficiary by his or her name. Or C, naming beneficiaries as a group. Or D, not naming no beneficiaries.
Well,
C.
D, let's go with C. And that is correct. Class designations are used when an insured chooses all distribution benefits among living beneficiaries and his or hers without naming each individual person as such as all my children. So let's just say, for example, remember some people when they get their life insurance, they say, okay, obviously wife and husband, if something happens to you and you would be the beneficiary. But if something happens to both of you, who would it be? And then it says all children's equal. That's class designation. So you're just signing a class basically. Does anybody have any
Yeah.
questions? Okay, let's go to the next one. Okay, which is not true about beneficiary designations? Okay,
which is not.
A, the policy does not have a beneficiary name in order to be valid. B, trust can be valid beneficiaries. C, the beneficiary must have insurable interest in the insured. Or D, the beneficiary may be a natural person. Okay, let's read it one more time. Okay, which is not true about beneficiary designation? A, the policy does not have to have a beneficiary name in order to be valid. Trust can be valid beneficiaries. The beneficiary must have an insurable interest in the insured. Or D, the beneficiary may be a natural person. Okay, so now let's do process of elimination. The beneficiary may be a natural person. what does that mean? So you could, you could leave your money to a church, right? You could leave your money to a hospital, right? So it doesn't necessarily have to be a person. So,
That's
okay.
eliminated.
And then C, the beneficiary must have insurable interest in somebody. What is this saying? So I can't just get insurance on my friend. There has to be some type of insurance. Either I'm depending on that person or that person is depending on me, or it's just a mutual interest, right? You just can't get insurance for somebody else, right? B, trust can be valid beneficiaries. So remember how I said about the trust could be somebody that takes care of your kids, take care of their money. That person can be a valid beneficiaries. Okay. Or A, the policy does not have to have a beneficiary name in order to be valid. So we're looking the one that is not true. So after I read them, which one sounds like it's not true?
Not true.
B,
B as in boy?
yes.
Okay. It's C,
Oh,
the beneficiary must have insurable interest.
oh, okay.
A beneficiary is a person or interest to whom the policy proceeds, will be paid upon the death of the insured beneficiary, do not have to have insurable interest in the policyholder. So the beneficiary must have insurable interest in the thing. No, the insurance doesn't have to have, it's like if it does, but if it doesn't in certain cases. Like I said, the only reason somebody could be assigned to somebody is if there's insurable interest in somebody, right? But the beneficiaries could be everybody.
Hmm. Okay.
To get insurance on somebody, like say if I want to get insurance on you, there has to be some type of insurable interest. The beneficiaries, it could be whatever. Like you could leave your money to your friend, you could leave the money to your neighbor, like you could leave it whoever you wish to leave it to. So you don't need insurable interest to be the beneficiary. You do need to be insurable interest when it comes to being a policy owner. Okay. Does anybody have any questions?
Oh, yeah.
That one
Yeah.
tricked me.
Quick question. Quick question. I mean, this is all related to life insurance, correct?
Yeah.
And it doesn't matter whether it's whole life, universal life, term
Right.
life. Okay, it could be any. Okay.
Yeah, anything. Even annuities have beneficiaries. Your retirement has beneficiaries. When it comes to beneficiaries, you could leave your money to whoever you want.
Okay.
Okay, let me go back to the answers because this is a little bit confusing. The policy does not have to have a beneficiary name in order to be valid. That is true. You don't have to leave your money to nobody. You could just, get your funeral paid and that's it. Right? That's true. The trust can be a valid beneficiary. That's true. Right? Obviously, whoever's going to want to take care of your kids, you would want to leave them some money, right? To take care of your
Right.
kids till they turn 18, right? The beneficiary must have insurable interest. You don't have to have insurable interest to be the beneficiary, just the policy owner. Just remember that. And D, the beneficiary may be a natural person. It doesn't have to be a person. You could leave your money to a church, hospital, nonprofit organizations, whoever you want.
Etc.
Okay.
Yes.
What is the purpose of a fixed period settlement option? A, to provide a guaranteed income for life. B, to provide a guaranteed amount of money each month. Or C, to provide a guaranteed income for a certain amount of time. Or D, to settle the insurance company's liability.
Okay. Let's say some of them process of elimination.
Let's do process of elimination. But I'm going to read it one more time, okay?
Okay.
What is the purpose of a fixed period settlement options? A, to provide a guaranteed income for life. B, to provide a guaranteed amount of money each month. C, to provide a guaranteed income for a certain amount of time. D, to settle the insurance company's liability. Okay, let's go to D. To settle the insurance company's liability. Liability is something that it's pretty much like, you know how the insurance for your car, there's full coverage and there is liability?
Right.
Right? Liability means something you could kind of rely on it, and it's something pretty much basic. Like it's just liable to pay. It's liable,
Yeah.
something like that. So if we know what that word means, now let's reread the answer. It says the settle of the insurance company's liability. Okay. So it has to be something that has to do with that. C, to provide guaranteed income for a certain amount of time. So what you say is, you know what, George, I want my kids for my retirement to receive $1,000 each month for 7 years. Okay.
Okay.
And then B, it provides a guaranteed amount of money each month. So what you say is you would want an amount each month. It's a different each month and each time. Because you could have 7,000 for 12 years. That's what C means. B means the amount each month. Say 2,000, 1,000, 600, right?
Yeah.
Or A, to provide guaranteed income for life.
That's
So now, if you know what a fixed period settlement option is, it will give you the option. To you guys, what does the word settlement mean?
worst. I think provide a guaranteed income for life.
Okay. So
That's
what
like that's way too much. A is like no. I don't think no insurance company guarantees income for life, as far as I know. I may be wrong, but the best one, okay, to settle the insurance company's liability, that's only a one payment, right?
Yeah.
So it will be B or C, B or C.
C.
Let's B as in boy.
No,
C.
I say B or C, B or C,
Come for a certain amount of time.
C,
Okay, let's
C.
go with C then. That is correct. When a fixed period settlement option is selected, the insurer agrees to pay the proceed in equal installments over a specific period of time. So fixed period, I don't know if you guys recall going through types of insurance. What does fixed period mean? Fixed period says that you could fix, it says on the word fixed period, like you could fix the period of time,
Right.
right? And
Certainly.
settlement means like to settle, like so for a certain amount of months, you settle that amount of money.
Question.
Yes.
Would this be kind of like insurance, like AFLAC?
Yeah, it could be like that. But the thing is, for fixed, it's a settlement, which is like it settles everything, right? So
Right.
let's think about what the question was saying. The question was saying, what's the purpose of something that is fixed period settlement? Something that you fix the period. So you decide what amount of money you want for a certain amount of period, and it
I
stays
see.
like that. Settlement means it settles.
Settles. Okay. Yeah. 1 year, 2 years, 3 years.
Yeah. So then now this is why to provide guaranteed income for a certain amount of time. So what you say a fixed period, you fix the period. It is if it would have been fixed premium or something, they would have been the amount of money.
Okay.
So it's right here. It was talking about period, like a time wise.
Right, like a time span. Time span.
Yeah, time span. So a good thing, guys, is always reread the questions and try to connect a word that you say, okay, period. What does period mean? Like a certain amount of time,
Right.
right?
Fixed period. Yeah.
And then you be like, okay, fixed period, and then try to connect it like that. Okay. Does anybody have any questions?
Nope.
Okay, let's go on to the next one. If a settlement option is not chosen by the policy owner or the beneficiary, which option will be used? Okay.
One more time.
A, lifetime. B, fixed period. C, fixed amount. Or D, lump sum.
The settlement option.
Let's read it one more time. If a settlement option is not chosen by the policy owner or the beneficiary, which amount will be used? A, life income. B, fixed period. C, fixed amount. D, lump sum. Let me tell you what lump sum is. Lump sum is they give you everything like that.
Yeah.
Like say you had $1 million in coverage, they'll give you $1 million just like that.
The whole
Okay.
amount.
Fixed amount, it's you fix the amount for each month.
Hmm.
Okay. Fixed period, you fix the period of the length of how much money they want. Okay.
Right.
So if they had let's just say your insurance was 700,000, right? So fixed amount, you said, okay, I want them to receive this amount of money each month until it's gone. Okay. Fixed period, you say, okay, in 10 years, I want this money to last 10 years. So then they break it down and say, okay, in 10 years, 100,000 or 400,000, they're going to receive this amount of money. Okay. Life income is for life. Okay. So which one sounds more accurate to the question?
Since nothing is decided, so I say D.
Okay. Does anybody want to say something else? Okay. Let's do D. That is correct. Upon the death of the insured or endowment, the contract is designed to pay the proceeds in cash, called the lump sum, unless the recipient chooses an optional mode of settlement. So if nobody decides how they want to receive their money, they'll just give it to you like that.
Yeah. The
But
whole bank.
yeah, they'll just give you like that, and some people will waste their money like in a week, right?
Right.
There's cases where they give an 18-year-old $700,000, right? An
Yeah.
18-year-old, you probably think it's a smart idea, but think about it. He went and bought out his friends' cars. He bought a car, you know, and boom, spammed it out his money. But
Yeah.
if you say, you know what, if we advise him to say, okay, so you have this amount of money, let's say it's better for you. You have little kids, right? Okay, so it's better for you to have it fixed amount. Okay, because you
Yeah.
know you're gonna be guaranteed this amount of money for a certain amount of period of time. Okay, or life income, you want it for life, so we'll put it like in an interest rate so you can live out of the interest. So it just
Right.
depending on how the beneficiary wants their money.
Okay.
Does anybody have any questions?
No.
Okay, let's go on to question number 9. The two types of I'm sorry. The two types of assignment are absolute and collateral, B, absolute and partial, C, complete and partial, D, complete and
Proportional.
proportionate. Let's read it one more time. The two types of assignment are absolute and collateral, B, absolute and partial, C, complete and partial, or D, complete and proportionate.
A.
A? Okay, does anybody have any other answer?
No.
I think
Okay,
H.
okay, let's do it. And that is correct. Absolute assigns the entire policy, collateral assigns a part of all the benefits. Okay, so the reason why the other ones were in is because you can pre and proportionate complete. This one was a little common sense, but it's basically the assignments are they're different. So the two assignments are those are absolute assigns and entire policy, collateral assigns are part of all the benefits. Okay.
Yeah.
Let's go to question number 10. All of the following statements concerning dividends are true, except, so we're looking one that is not correct, okay? A, variable investments results generate higher dividends. B, dividends amount are guaranteed in the policy. C, lower insurance company costs generate higher dividends. D, they stem for affordable underwriting experience. Let's read it one more time. All of the following statements concerning dividends are true except A, for affordable investments results generate higher dividends. B, dividend amount are guaranteed in the policy. C, lower insurance company costs generate higher dividends. D, they stem favorable underwriting experience. Okay, let's do process of elimination. They stand for affordable underwriting experience. So underwriting is whenever you're about to be qualified and they're either doing medical records, phone calls, that's underwriting. So they stand for affordable underwriting experience. They lower insurance company costs that generates more dividends. So you'll pay less on your insurance so you could get more interest, more dividends. B, dividends amount are guaranteed in the policy. A, favorable investments results in generate higher dividends. Which one's not correct?
Is it B?
Oh,
B?
Dividends amounts are guaranteed in the policy?
Okay, let's try B. That is correct. Dividends cannot be guaranteed. Let's just look at dividends as interest, right? I can't guarantee you that you're gonna be receiving this amount of money based on interest because we don't know if the stock market is gonna go like that or it's gonna go like that. So we always like to keep it in one, which is 9. If it does better, it usually does better like on 12. Great. If it doesn't, I can't say, oh, it's gonna be more or it's gonna be less. We keep it at 9 just in case it goes boop, it'll go up and it'll still be at 9. But if it goes extremely up, you're like, wow, you made a lot of money instead of like, wait, you lost a lot of money. So you like to keep it in a simple conservative number, and no interest can be guaranteed. Okay. Anybody have any questions?
no,
Okay.
learning something new.
The owner of a life insurance policy wishes to name 2 beneficiaries for the policy proceeds. Let me move this out of the way. Okay. What will the soliciting insurance producer say? A, the proceeds will be split evenly between the 2 beneficiaries. The policy owner can specify the way proceeds are split on the policy. D, the way proceeds are split between beneficiaries is decided by which type of policy is chosen. D, life insurance policy may have only one beneficiary. Okay,
B as in boy?
so what was that?
Was it B as in boy?
B, let's do B.
Yes, B.
That is correct.
Yeah.
The owner of the life insurance policy may name any individual as a beneficiary. As the policy proceeds, the owner may name more than one individual. In most cases, the individual beneficiary will split the beneficiary percentage specified in the policy. Let me tell you why it's not D. D, life policies may only have one beneficiary. You could have multiple beneficiaries as long as it equals 100%. So if you want to put 100 people and leave 1% to each people, you could do that. Right?
Yeah.
If you want to leave 3 people divided in 100%, that's what you would do, as long as it equals 100%. Okay.
Right.
It can be C because the way proceeds are split between beneficiary is decided by which policy is chosen. It doesn't matter about beneficiary because you could get whole life, universal, index. It doesn't matter. Beneficiaries applies to everybody. Okay. Whether you get whole life, whether you get term, beneficiaries are always the same for all insurance companies. Okay. B, proceeds will be split evenly between the 2 beneficiaries. That one was a little confusing, but the person doesn't decide, is the policy owner that does. Okay.
Right.
Does anybody have any questions?
No.
Okay, let's do the last one for this one. Okay, how does an insured typically decide which settlement option to choose for his or her beneficiary? He or she usually decides based on how many beneficiaries he or she has chosen to receive benefits. B, he or she typically decides based on the advice of the insurer. C, his or hers decides based on the amount of that benefit. D, his or hers typically decides by determining if the beneficiary will need one payment or a steady stream of income. Let's read it one more time. How does an insured typically decide which settlement option to choose for his or her beneficiary? A, he or she usually decides based on how many beneficiaries he or she has chosen to receive benefits. B, he or she typically decides based on the advice of the insurer. Or C, he or she decides based on the amount of the death benefit. Or D, he or she typically decides by determining if the beneficiary will need a one-time payment or a steady of the income.
Is it D?
You guys want to do D? Let's do D. And that is correct. Typically, the settlement option is chosen by determining if the beneficiary will need one payment or income over a period of time. Just remember when I told you guys, okay, so when I told you a payment, a steady stream, or an income, that's pretty much what would decide it. That would definitely determine it, because you would want to know, okay, do you need it in lump sum? Do they need it in a period of time? Are the kids 6, 7 years old, or are they 18, 19, where they could get all their money? Does that make sense?
Yes.
Okay. So we actually scored an 83, guys. Congratulations. So what do you guys think about this one? This chapter?
Oh, well, it's part of learning this because
Do
everything is new for me, basically.
Okay, do you guys want to do the same one, the same chapter, another test, or you guys want to go to another chapter?
Another
Um, another
Okay,
chapter.
let's do another chapter. Okay, so the next one we're gonna do is life policy writers. Okay.
Right. Policy writers.
Okay. Mark this one. Okay. Question number 1. Which of the following annuity writers ensures investors will receive a set amount of income annually? A, guaranteed lifetime earnings. B, guaranteed lifetime withdrawal. C, guaranteed minimum income benefit. Or D, guaranteed minimum accumulation benefit. Let's read it one more time. Which of the following annuity writers ensures investors will receive a set amount of income annually? Guaranteed lifetime earning, guaranteed lifetime withdrawal, guaranteed minimum income benefit, or guaranteed minimum accumulation benefits. Let's do process of elimination first, okay? D, guaranteed minimum accumulation benefits. So you have guaranteed the minimum of what's gonna accumulate, right? C, you're gonna guarantee minimum income benefit. So whatever income is, you're gonna be guaranteed the minimum. Or guaranteed lifetime withdrawal, where you could take out anytime you want. Or A, guaranteed lifetime earnings. So for a lifetime, you would have a certain amount of earnings. Which one sounds more accurate to the question?
It's either B or C.
Okay. Eeny, meeny, miny,
I
mo.
think C.
See, let's do C then. That is correct. The guaranteed minimum income benefit provides a set annually income no matter how, let me move this out of the way, no matter how the underlying investments perform. So for a certain amount of period, whether it goes up and down, if you say, you know what, if you're guaranteeing the minimum, everything that is minimum, it's mostly guaranteed, okay? Because you don't risk it. You stay stable. If it's high risk, then you would get more money. But since it's minimum, you would have guaranteed minimum income benefits for an annual income, no matter how is it doing up or is doing good. Does anybody have any questions with this one?
No. Nope.
Okay, let's go on to the next one. 2. What is the waiting period on a waiver of premium rider in life insurance policies? Okay. A, 30 days. B, 3 months. C, 5 months. D, 6 months. Let's read it one more time. Maybe something's going to click to you guys. What is the waiting period on a waiver of premium rider in life insurance policies? A, 30 days. B, 3 months. C, 5 months. D, 6 months. Let me tell you guys this. Do you guys remember whenever we said we sit down with people with you guys and we went over the waiver? Do you guys know what waiver of premium is?
Like not paying for a particular time, so to speak.
Yeah, if somebody, well, the policy owner has they
Disability.
they get a total disability for 6 months. If they pay for 6 months, what they do is the company will reimburse them for the 6 months, and they will take over the payment of it for life until they go back to work.
Okay,
Okay, but right
So-
here it is 6 months.
6 months.
Okay, 6 months. Most insurer impose 6 months waiting period from the table disability until first premium is waived. Okay, so
Right,
basically you would pay for 6 months. After 6 months, they reimburse you 6 months, and you have free insurance. Either something happens to you or you go back to work.
Okay.
All of the following topics may be included in the counting education requirement for long-term care insurance. Let me move this out the way. Except, remember, now it's saying except sales
Continue.
techniques and overcoming clients' objectives and purchase of a long-term care insurance. B, available long-term care service and facilities. C, alternatives to purchase a private long-term care insurance. D, the effect of inflation in enrolling the value of benefits and the importance of inflation protection.
A.
A,
I think A too.
okay, let's go with A. It's actually, wow, you guys are on fire. Come on, okay. It says, training courses on the sales techniques of overcoming client objections are not approved continuing education. And topics. So overcoming objections is if a client tells you, hey, I don't have money to pay my life insurance, or hey, I just, it's not for the time right now. That's not continuing education. Continuing education is more of like laws and not overcoming objections. That one was kind of like a common sense, right?
Yep.
Okay. Does anybody have any questions with this one?
Nope.
Okay, let's go to number 4. Every long-term care insurer in California must submit the commissioner a list of all agents and their insured representative authorizing to solicit individual customers for the sale of long-term care insurance. This submit agent list must be updated at least A, semi-annually, B, monthly, C, quarterly, or D, annually.
A.
A.
All right, let's do A. That is correct. According to the CIC 1023, the insurer must submit an updated list semi-annually of all agents authorized to solicit. Okay, to solicit long-term care insurance. So every semi-annually, so every 6 months they have to do a report of who's the one selling or who's the one educating families in that area. Okay. Does anybody have any questions?
Nope.
Okay. Oh, what I do? Okay. All of the following are features and requirements of the living needs rider, except, remember, we're looking at one that is wrong, okay? A, the remainder of the policy proceeds is payable to the beneficiary as insured's death. B, it provides funds for medical and nursing home expenses to terminal ill insured. C, it diagnosed most indicate that and is expected within the 3 years. D, it's usually available at no additional cost. Let's read it one more time. All of the following are features and requirements of living needs rider except A, the remainder of the policy proceeds is payable to the beneficiary of the insurance death. B, it provides funds for medical and nursing home expense to a terminal ill insured. C, diagnosis must indicate the death is expected within 3 years. D, it is usually available at no additional charge. Which one do you guys think it is?
B,
B as in boy?
B,
Yeah.
it usually is usually
What?
available at no charge.
Let's
B?
do that one. Let's see if it's C. Diagnosed must indicate the death is expected within the 3 years. That's not
No,
right. A
that's
living needs rider. It's for people that they need like elderly taken care of. That's a rider. But diagnosis must indicate that death is expected in 3 years. That does have nothing to do with
Yes.
it. That's actually
2 years.
false. They can pretty much expect you to die in 3 years. The limiting rider provides for the payment of part of the policy's death benefit if the insured is diagnosed with a terminal illness that will result in death within the 2 years. Okay. Okay, let's go with question number 6. Which of the following statement best describes the effect the accelerated benefit provision would have the benefit paid to the beneficiary? A, it will reduce the benefits by 70%. B, it will be increased the benefit to the beneficiary. C, it will decrease the benefits paid to the beneficiary. D, it will not affect the benefits paid to the beneficiary. Let's read it one more time. Which of the following statement best describes the effect that the accelerated benefit provision would have on the benefits paid to the beneficiary? It will reduce the benefit by 70%. It will increase the benefit paid to the beneficiary. It will decrease the benefits to pay to the beneficiary. Or D, it will not affect the benefits paid on the beneficiary.
Is it B?
I would say, it would be C. I say C, isn't it? C is Charlie.
And mini, mo. Okay. Oh, D. Actually, C, you are correct.
Yeah,
It
because
would take, go for it, go for it.
no, it would eventually, let's say, for example, someone who's terminally ill, they say the policy is 200,000. So they have to pay 100,000 on whatever medical bills. And then once the person, deceases, I guess they'll pay the rest, right?
Yeah,
They will
so what
decrease the benefits.
happened, we know it as the terminal illness rider, but it's the same one. So what you could do, you could pull out 40 to 70% while you're still alive. For what? For alternative medicine. You could pay off your bills and live a happy life, right? Or just have that extra money and not worry about bills. And the
Right.
rest will be given to your family. Okay.
Okay.
Does anybody have any questions?
Nope.
Okay. Next one. 7. All of the following are responsibilities of every long-term care insurer in California except A, provide enough business to solicit term life insurance care. B, establish marketing procedures to assure that any component of policy will be fair and accurate. C, establish marketing procedures to assure excessive insurance is not sold or issued. B, submit the consumer a list of all agents authorized to solicit individual customers for the sale of long-term care insurance. So which one's the one that's not it? Which one's false?
C?
D as in dog or D as in boy?
Yeah,
I mean,
No, A, provide enough business to solicit a long-term care insurance. A.
okay. Okay. That is correct. Long-term care insurance must maintain strict requirements. This include establishing marketing procedures to assure that conversion is fair and accurate and is assure that expense insurance is not sold. In addition, insurance must semi-annually submit the consumer a list of agent authorized to solicit the sale of long-term care insurance. So when it comes to long-term care insurance, it's one of the strictest one to do. The reason why is like every 6 months you have to be doing like pretty much like a little course, see how everything's doing, and things that you can't do. You really can't. This one's a really hard one to sell because you can't really show examples of long-term care. The reason why is because when you say, oh, look at this senior home and how they treat this person, whatever, then you go by the idea that like, oh well, I'm gonna live that life too. I'm gonna go to that same senior center, but your long-term care is only worth $70,000 and the one that I showed you was 100,000. You're already gonna be old and you're gonna be disappointed, right?
Yep.
So it's really hard to that one to get somebody to buy it because you can't really give examples. Okay.
Right.
Okay, a rider that may be attached to a life insurance policy that will adjust the face amount based upon a specific index, such as the consumer price index is called. A, accelerated benefit rider, living need rider. C, payer rider. D, cost of living rider. Let's read it one more time. A rider that may be attached to a life insurance policy that will adjust the face amount based upon a specific index, such as the consumer price index is called. A, accelerated benefit rider. B, living need rider. C, buyer rider. D, cost of living. We definitely know it's not A, because accelerated benefit means when you have that terminal illness.
Right.
So now we're stuck with B, C, and D.
Is it B as in boy?
Okay, let's try it.
D.
Oh, D, eeny, meeny, miny, mo. Go with D. It is D. A cost of living rider adjusts the face amount of policy to maintain the relationship of the face amount and increases in the cost of living. So when it comes to index, some index will keep on going up just because it's the cost of living always goes up and it never goes down. Okay. Nowadays, back in the years, a gallon of milk was like super cheap. Now it's like extremely, it's like almost $5 a gallon of milk, right? And nothing gets lower, everything just keeps getting up, just like index does. You know what I mean?
Yep.
Okay. Which of the following statements is true concerning the accidental death rider? A, it is also known as a triple indemnity rider. This rider is only available to insure over the age of 65. C, it is only available in group insurance. D, it will pay double or triple the face amount. Okay.
Yes. D.
D.
I think
Okay.
D.
And that is correct. The seller benefit rider, 2 or 3 times the face amount of death results in accident is defined in the policy and occurs within 90 days of such an accident. So what's a good thing and bad thing about having ADR, which is an accidental death or dismemberment rider, is that it has to be in 90 days. So let's just say you got a car accident, right? But it was an accident. So you were still in the hospital for 90 days and you died on the 100th day, they would just pay the normal amount, not the full one that you say, well, if I die in an accident, I want 200,000 more. So if you had 100,000, but with that rider, if you die in an accident, they'll give you 200,000 because we never know what we're gonna die. So might as well get a little rider such as thing like that. But you have to be in 90 days based on that accident, right? If you die on day 100 or 91, they won't cover you. They'll just cover you with 100,000. Does that make sense?
Yes. Yes.
Okay. 10. The waiver of cost of insurance rider is found in what type of insurance? A, juvenile life. B, universal life. C, whole life. D, joint and survivor. Let's read it one more time, okay? The waiver of cost of insurance rider is found in what type of insurance? A, juvenile life. B, universal life. C, whole life. D, joint and survivor.
I'm trying to.
D.
It's either A or D. A or D.
What other answers do you guys have?
B or C.
All right, most people pick B. Let's go B. That is
Oh.
correct. The waiver of cost of insurance rider is found in universal life policies. If the insured becomes disabled, the rider allows the cost of insurance to be waived with the exception of premium costs required to ascertain cash value. Okay, so just in cash value, forget it. You have that one, okay?
Okay.
All of the following are true regarding the guaranteed insurability rider, except which one's the wrong one, okay? Follow me on this one. A, this rider is available to all insureds with no additional premium. B, the insured may be purchased additional coverage at a attained age. C, the insured may purchase additional insurance up to the amount specified in the base policy. D, it allows the insured to purchase additional amount of insurance without providing insurability only at specific date and event. Okay, which one do you guys feel like it is?
Guarantee. Insurability.
So which one's
Uh,
wrong?
Which one's wrong? Is it A? Because if it's a rider's available, you have to pay an additional premium, right?
Okay, let's try this one. That is correct. The
Yeah.
guarantee insurability rider may be structured to allow for a specific additional amount of insurance to be purchased at specific age, dates, and event without providing insurability. However, the coverage is purchased at the insurer's attained age, and the maximum allowable purchase is specified on base policy. The rider is usually experienced to the insurer's age 40. So let me break it down like this. The rider guarantee insurability, let's just say you got insurance for 30 years, right? Passing the 30 years, if you still want life insurance, you don't have to see if you qualify. You don't have to see nothing. It is going to be pricey because now you're not paying it as a 30-year-old, you're paying it as a 60-year-old.
Right.
So now the payment changed, but if you already have cancer, if you have diabetes, if you have some type of disease or something, you don't have to go to thing and they'll cover you. Okay. Last one, guys. You guys got this. A provision in a life insurance policy that provides for the early payment of some portion of the policy face amount should the insured suffer from a terminal illness or injury is called waiver of maturity provision, accelerated benefit provision, medical settlement provision, or automatic premium loan provision.
It's B.
accelerated.
B.
That is correct, guys. And it's accelerated. It's the same one. Like I say, you get a monthly installment over a special period of time. This provision is given without increasing premiums. Some companies, however, deduct an insurance charge and proceeds paid out and make up for their lost earnings. Okay. So we did a good job. We actually got an 83 again. Guys, you guys are amazing.
All right. Got a good picture.
So do you guys have any questions for me?
No, I guess it's I'm cool with all the answers.
Okay.
None, just to thank you.
Yeah, don't worry. Don't forget at each time there's always going to be a different professor, and each professor does a whole different teaching, I guess. So yeah, don't forget to plug into other ones. There are going to be other ones eventually. Every day there's one at 9. So bring in with your team, coming in ready. We love you guys and wish you guys nothing but the best. Good luck, guys, and see you guys next Tuesday, or see you guys whenever it's you guys in
All right.
next class.
Take care. Goodbye.
All right.